So list the items as they appeared in the question. So we had basic salary. And the basic salary was 650. Yes. Then there were 2 watchmen. There was a day watchman being paid 10,000 per month, but you multiply by 12 months to get 120. Then there was a night watchman. The night watchman was being paid 13,000. For 12 months is how much? 156. So 156,000. What was next? Furniture. So there was furniture. So furniture you get 1% per month of the initial cost was 380. Yes. 380,000 times 12 months, you get how much? 5,600. Then there was a car. So there was a car. We start by looking at the engine capacity CC rating. It was 2,000 cc, which is 86. 400. You compare with 2% per month. The initial cost was how much? 1.8 million. So 2%. By this rate, you're usually not given. So you have to remember. Whatever else the examiner doesn't give you, have to remember. You multiply by 12 months and you get 432,000. So you get 432,000. Out of these two, you choose the highest. So the highest is 432,000. Then he was provided with electricity and water. Was it? There was first per diem, eh? Per diem ilikuwa ngapi? 6,000 per day for 5 days. 6 days. 6 days. Yes. So kulikuwa na per diem ama ukipenda subsistence allowance, but mara nyingi examiner anaita per diem. So alikuwa anapewa 6,000. Yes. 6,000 per day. Out of 6,000, 2,000 will not be taxed. How many days? 6 days. So we multiply by 6. So that's 24,000. Then kuna electricity, eh? So electricity tulisema either you use the actual bill or the rates given in the past papers, whichever is higher. But in our case, the actual bill was not provided, so we refer to the table when the actual bills are not provided. If they are provided, you compare and you choose the higher. So for electricity, is 18,000 a year or 1,500 a month. Water bills, the prescribed amount is 500 a month or 6,000 a year. For what? Then the next was? There's no water. Yes. Sikusema maji. I have squeezed somewhere. Ongeza electricity and water. It was supposed to have been there. Because sasa, I was supposed to include most of the items you've done, so we cannot leave out electricity because electricity and water represents services. What tumefanya services, I wanted that included in the illustration. Then the next should be telephone, eh? See, telephone. So telephone bill, nachukua 30%. They said an average of 4,000 a month.
Yes.
An average of 4,000 a month. Now times 12 months. You will put ngapi? 14,400. Then akapewa free company products. Ndio. Tulisema company products is taxable as long as the value is 3,000 or more. This one was 3,500. So free company products. So you take 3,500 times 12 months and you get
42,000.
42,000. So once you've done that, the total addition of this is what gives you the total taxable income. If you add this, you get the taxable income. That is what we tax. Tunatumia graduated scale to tax that. So the total of this will give us the taxable income of Mr. Olimboga. So we'll just add. So the taxable income is 1507 600. So the last non-cash benefit was motor vehicle benefit. Motor vehicle benefit ilikuwa F ama G. F. Motor vehicle benefit uliita nini? F. F ilikuwa car benefit. Sijui nasema motor vehicle benefit. Kaa sio motor vehicle. Sasa tafanya G. G tunasema housing benefit. G tunasema housing benefit. That's the next non-cash benefit. So for purposes of housing benefit, we'll be dividing employees into 4 categories. Then we'll be looking at each. I'm told Rehab has raised her hand, so you can ask your question. I've not muted the classes yet, so you can unmute yourself and ask. Yes.
Just a quick one, eh?
Yes.
Please explain how you got on the car benefit, how you got the 86,400.
86,400 is on your table. If you look at you have access to the exam past papers. Those rates provided there. They give you that.
All right.
Once the examiner has given you the CC rating, then you take that CC, that becomes, you refer to the table and you get the 86,400. There is a monthly rate and there's an annual rate. 86,400 is annual. Monthly 7,200. Those rates are provided.
All right. Thank you.
So we have housing benefit. We are going to have 4 categories. for housing benefit. The first category is going to be ordinary employees. And this thing has refused to write. It's going to be ordinary employees and whole-time service directors. So we call this ordinary, I'll call it Roman 1. Ordinary employees, and whole-time. Ordinary employees and whole-time service directors. So you can abbreviate that to WTSDs. WTSDs. So that's would be our first category we'll be looking at. Then we have agricultural employees. Agricultural employees. Then Roman 3, we have non full-time service directors and whole-time service directors. We call them non-WTSDs. Then 4, we have employees provided with book. Employees provided with book, accommodation and meals. Employees provided with book, accommodation and meals. So let's take as a subheading, the first category is called ordinary employees and full-time service directors. Ordinary employees and whole-time service directors. Ordinary employees and whole-time service directors. So you say a whole-time service director, a whole-time service director, a whole-time service director, a whole-time service director is one who does not, own more than 5%. Is one who does not own more than 5% of the total share capital. Is one who does not own more than 5% of the total share capital of the company. Is one who does not own more than 5% of the total share capital of the company. And he serves the company, or he has devoted for it. So he has devoted a significant amount. He has devoted a significant amount. He has devoted a significant amount of time. He has devoted a significant amount of time in the company. He has devoted a significant amount of time in the company, serving as a director. Serving as a director. Serving as a director. When you say the housing benefit shall be determined, the housing benefit shall be determined as the higher of, the housing benefit shall be determined as the higher of, the housing benefit shall be determined as the higher of Roman 1, 15% of total gains from employment, 15% of total gains from employment, 15% of total gains from employment, 15% of total gains from employment. Or Roman 2, market rental value of the house. Market rental value of the house. Market rental value of the house market rental value of the house. The new paragraph below that you see, less his own contribution. Less his own contribution. Less his own contribution towards rent. Less his own contribution towards rent. Okay, so we take our second illustration to illustrate that category. So we can call it illustration or we call it example, whichever you're comfortable with. So we'll use the same illustration. So illustration, you say, assume that Mr. Olemboga in the previous illustration, assume that Mr. Olemboga in the previous illustration was provided with a company house. Assume that Mr. Olemboga in the previous illustration was provided with a company house and put a column number 1. And number 1, the market rental value of the house, the market rental value of the house, the market rental value of the house, the market rental value of the house was 35,000 shillings per month. The market rental value of the house was 35,000 shillings per month. And number 2, the company deducted nominal rent. The company deducted nominal rent of 20,000 shillings per month from his salary. The company deducted nominal rent of 20,000 shillings per month from his salary. 20,000 shillings per month from his salary. Required, compute the housing benefit for Mr. Olemboga. Compute the housing benefit for Mr. Olemboga. Compute the housing benefit for Mr. Olemboga. So this is what we said. So we want to compute housing benefit. So housing benefits. So first of all, you get from 1, 15% of total gains from employment. This is the total gains for employment. So you multiply by 1507, 600, that's the total gains from employment. So we do that, 15% of 1507, 600, and you get 226, 140, so that's 15%. Then Roman 2, we get a market rental value. So the market rental value of the house is 35,000 per month. You multiply that by 12, and you get 420,000. Out of this, you choose the highest. So tutasema HB, short for housing benefit, is the higher between the two, so that the higher amount is 420,000. Then you say less the nominal rent, his own contribution. So the nominal rent deducted was 20,000 a month. So 20,000 a month, you multiply, you get 240. So you subtract 240 here. Whatever remains, there have been housing benefits, which you add the other benefits Olemboga had. So 420,000, you subtract 240. The difference is 180. That is what would have added as housing benefit. Then we can bring in the next category. That was the first category. We had 4 categories. The next category is called agricultural employees. Agricultural employees. Hey, what is the question now? You're asking which year? How relevant is the year? Marcia anauliza which year was this? I've just said 31st December 2022. And I'll be using that deliberately because your tax year will be 2022, not 2023. Your exam is based on a complete year, so I'm doing that deliberately. Unless sijaelewa unauliza nini. There's no question paper here. This was an illustration. So you just written the illustration. Question paper gani? Walikuwa nauliza reference ya question paper. Hii haikutoka kwa question paper. You just dictated it and answered. Sindio? We are not ready to answer a question paper yet. After tumebuild hizi benefits tukimaliza, then we'll be ready to look at our question paper. Sahi bado, there are a number of things bado sija introduce. Nikimaliza, we'll definitely look at a past paper question. Next category of employees, tunasema agricultural employees. Agricultural employees. Agricultural employees. Then you say, these are employees. These are employees. These are employees whose engagement. These are employees whose engagement is in plantations or farms, FA, in plantations or farms, or other agricultural enterprises, These are employees whose engagement is in plantations or farms or other agricultural enterprises. Then you say housing benefit shall be determined as follows. 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 %10 times the total gains from employment. 10% from the total times total gains from employment. 10% times total gains from employment. 10% times total gains from employment. So you'll notice that the government deliberately through taxation tries in their own way to motivate people, young people, to go into agriculture. You notice that even for benefits, for electricity, for those in agriculture, it will be 900. Those rates are provided, 900 per month prescribed. For water, it will be 200. While for other employees elsewhere, it's 500. You can see for housing benefit, for other categories of employees, it's 15% of gains from employment. For those in agriculture, it is 10%. That's deliberate way that probably if people can know before they start work, they can say, well, there are some very attractive incentives to go into agriculture. Or I'm told taxable income was higher, 1508.
Yes.
It's 1508.
The telephone was 14,400.
And you told me 14. So this is 1508.
Yes.
That changes matters a little bit.
1,000.
Or there's no 600 now. So 1508. So this is 1508,000. So it changes just the 15%. 15% itakuwa ngapi? 226,200. So the high is still 420, but some things changed a little bit. Just a little bit. So the next category is non-whole-time service directors. Non-whole-time. Non-whole-time service directors. Non-whole-time service directors. Non-whole-time service directors. When you say these are directors, these are directors who own. These are directors who own more than 5%. These are directors who own more than 5%. Thank you. These are directors who own more than 5% of the total share capital. These are directors who own more than 5% of the total share capital, more than 5% of the total share capital of the company, and are not engaged as directors in the company, and are not engaged as directors in the company on full-time basis, are not engaged as directors of the company on full-time basis. Housing benefit shall be the higher. Housing benefit shall be the higher of the following. Housing benefit shall be the higher of the following. Housing benefit shall be the higher of the following. Roman 1, 15% of total gains. 15% of total gains from all sources. 15% of total gains from all sources. 15% of total gains from all sources, e.g., employment, business, rental income, etc., or market rental value of the house, market rental value of the house, or Roman 2, market rental value of the house, market rental value of the house. Then a new paragraph, we say, less his own contribution, less his own contribution towards rent. Less his own contribution towards rent. Less his own contribution towards rent. Then the last category, we say employees provided with both. Employees provided with both accommodation and meals. Employees provided with both accommodation and meals. Employees provided with both accommodation and meals. So you say these are employees. These are employees who derive. These are employees who derive both accommodation and meals from employment, both accommodation and meals from employment, both accommodation and meals from employment, such as hotel workers, Housing benefit shall be determined as follows. 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 20% times total gains from employment. 20% times total gains from employment. 20% times total gains from employment. So that will be the highest because their benefit is also more. They're getting housing and they're also getting meals. So theirs will be the highest. So that's housing benefit. Housing benefit was G. So now you go to H, you call that fringe benefit. The other non-cash benefit, you call it H, fringe benefit. So H is fringe benefit. Fringe benefit, and we say these are loans. These are loans granted to the employee. These are loans granted to the employee. These are loans granted to the employee at an interest rate that is lower. And at an interest rate that is lower. At an interest rate that is lower than the market or prescribed interest rate. At an interest rate that is lower than the market or prescribed interest rate. Then you say fringe benefit is computed. Fringe benefit is computed by a formula. Fringe benefit is computed by a formula. So you put a column and you say fringe benefit. The fringe benefit would be amount of loan. You multiply by market interest rates. That's low interest rate. That gives you fringe benefit. The new paragraph, you say fringe benefit tax. Fringe benefit tax is chargeable. Fringe benefit tax is chargeable at the corporation tax rate. Fringe benefit tax is chargeable at the corporation tax rate of 30%. Fringe benefit tax is chargeable at the corporation tax rate of 30% and is payable by the employer. And is payable by the employer. And is payable by the employer. Then you say, i.e., now we show the fringe benefit tax. The fringe benefit tax. Call that FBT. Is fringe benefits. You multiply by corporation tax rate. The corporation tax rate is 30%. This rate here is 30%. So take an illustration on that, or you can call it an example, if you will. Example, you see, Mr. Kasuku was granted a loan. Mr. Kasuku was granted a loan. Mr. Kasuku was granted a loan of 2 million shillings. Mr. Kasuku was granted a loan of 2 million shillings by his employer was granted a loan of 2 million shillings by his employer at an interest rate of 5% per annum, at an interest rate of 5% per annum, an interest rate of 5% per annum, the prescribed or market interest rate, the prescribed or market interest rate, the prescribed or market interest rate was 10%, was 10% per annum. The prescribed or market interest rate was 10% per annum required. Compute the fringe benefit tax. Compute the fringe benefit tax. Compute the fringe benefit tax payable by the employer. Compute the fringe benefit tax payable by the employer. Compute the fringe benefit tax payable by the employer. So you calculate that. You have the formula, so you calculate the fringe benefit tax. So umepata fringe benefit tax ni ngapi? 30,000. And that 30,000 will be paid by the employer. So that tells you, if you find the examiner has given Ida pia anasema, Ida anasema ni 30,000, that's correct. So ukipata that information in an exam situation, unless the examiner anakuuliza kando, kwamba ucalculate fringe benefit tax. When you're calculating taxable income of an employee, this will not be included. But kando, the examiner could have provided that information to test you. Kama utaweka kwa taxable income. It's not supposed to be in taxable income. But if later he asks you, can you calculate fringe benefit tax, then you can show him if he asks. But among taxable incomes of the employee, you cannot include this because who pays the tax? It is the employer. It is the non-taxable benefit. So the next one should be I. Put gifts and rewards. I is gifts and rewards. So gifts and rewards. I'm sure you must be wondering whether we are about to tax gifts. Unajua, tax is becoming very controversial. So the truth is, gifts are not taxable. We don't tax gifts. Like if you get a gift from a friend, don't expect KRA will expect you to part with tax out of a gift. No, generally, a gift from a friend or even a birthday gift or that kind of gift will not be taxable. But there are circumstances under which a gift will be taxed. For example, if there's a gift from the employer, he could call it long service award or Christmas gift or whatever he calls it, or probably you're voted as the best marketer for that year or the best probably improved employee, and you're given some cash gift to come with it, then it must be taxed. The reason why it's taxed is already there's a contract of employment between the employer and the employee. So it's considered that anything coming from the employer is because of that contract. He's not paying you as a stranger. He's paying you because you are an employee of the company. The other circumstances under which you tax a gift is if it's from a customer and is paid in connection with your work, when you're working. So even if your customer meets you and buys you a cup of tea later in the evening, we are not talking about that. But we're saying what you receive when you're in your position of work. So technically speaking, our policemen should be paying tax on whatever they collect on the road. Because what they collect in the course of work. But yes, strictly speaking, they should. So that extends it to those who work in the hotel, like waiters. Waiters get tips. We are not very famous in this part of the world for tipping waiters, but across the world, people have learned to appreciate service. So when you serve very well and somebody has been smiling and they've put effort, you don't pick everything from the source. When he brings, which will be everything and you're also smiling back and you put everything in your pocket. It's just kind, it's just nice. It's considered to be good manners, to say thank you in a way. I was being told of a guy who works in one of the hotels, and then he's a cleaner, but he loves his work because he gets a lot of tips. One of the local hotels here, because those who come to that hotel and visit some of the areas when he's cleaning, they leave him with hard currency. What won't tip in dollars? This guy, I understand over the weekend, the guy is able to drive a Mercedes, probably not a new one, but he knew to have pushed himself to that ambition of driving a Mac. While his job description, then it means these tips are something significant. Indeed, this year, I read about a case that happened in one of the London hotels that some tycoon, I can't remember his name, went to have something. I don't know what he had in that hotel, but he left something like 60,000 sterling pounds. And of course, the manager got this information and he said, to be fair, this is a lot of money. We cannot say we're going to award only the person who had offered the service. Why don't we share staff? So those who are working that shift, well, all got part of this. It's supposed to be added to your salary so that it is tax. It's income because you got it in connection with employment. Ukupata huko nje. Unajua ukipata gifting up huko nje, there's no tax. But having said that, probably the manager might plead he's ignorant, he doesn't know, probably might not even include this in the taxable income. But strictly speaking, it's supposed to be part of the income. So gifts and rewards, that's I say, generally, gifts are not considered as taxable. Generally, gifts are not considered as taxable income. Generally, gifts are not considered as taxable income, e.g., a gift from a friend, e.g., a gift from a friend, e.g., a gift from a friend. However, if a gift is received by virtue of employment, for services rendered, it is a taxable income. It is a taxable income on the employee. It is a taxable income on the employee. It is a taxable income on the employee. e.g., tips to a waiter, Christmas gifts, or long service awards, Christmas gifts or long service awards to employees. Christmas gifts or long service awards to employees. So those are the cash receipts from employment and non-cash receipts from employment. Now we turn to something called non-taxable benefits from employment. Non-taxable benefits. Non-taxable benefits from employment. So these are benefits from employment which will not be taxable. They are non-taxable benefits. Okay? So just list them. Number one, facilities granted. Facilities granted to the employee. Facilities granted to the employee whose aggregate value. Facilities granted to an employee whose aggregate value is less than 3,000 shillings per month. Whose aggregate value is less than 3,000 shillings per month. Whose aggregate value is less than 3,000 shillings per month, or in brackets, 36,000 shillings per annum. 36,000 shillings per annum. Number two, free meals provided by the employer. Free meals provided by the employer. Free meals provided by the employer whose value is less. Whose value is less than 4,000 shillings per month. Whose value is less than 4,000 shillings per month. Whose value is less than 4,000 shillings per month. In brackets, 48,000 shillings per annum. Number three, school fees. School fees paid for the employee or his dependents. School fees paid for the employee or his dependents. School fees paid for the employee or his dependents. Provided that it is taxed on the employer. Provided that it is taxed on the employer. Provided that it is taxed on the employer. Number four, medical benefits. Medical benefits provided under a medical scheme. Medical benefits provided under a medical scheme. Medical benefits provided under a medical scheme, which is non-discriminatory. So school fees and medical, okay, all of them, there's a condition, isn't it? It's not just a non-taxable benefit, there's a condition. For free meals, the condition is the value. So if you're told the meals that were being provided did not reach a value of 4,000 a month or 48,000, then it's non-taxable. For school fees, we've given a condition, provided that it is taxed on the employer. So the question will give you the context. If you read the question, the examiner's language will tell you whether the employer has paid fees or not. For example, we might use a language like this. It can tell you that school fees was allowable as an expense, was allowable or was okay. school fees was allowable in the accounts of the company. You know what that means? That when you are deducting the expenses, one of the expenses was school fees. So if they pay tax on what was left, it means they did not pay tax on the school fees. So the language of the examiner will tell you if the company had paid tax or not. If they tell you school fees was disallowed as an expense, it means they could not bring it as one of the expenses. It was disallowed. It means they pay tax on it. Then it will be tax-free on the employee. Then for medical, there's only one condition. It must be non-discriminatory. So if the examiner, for example, says that the employees had enjoyed a medical medical benefits, but there was a scheme for all employees, then it means it's not discriminatory. But sometimes the examiner tells you it was for management staff. So if it was for management, it means there are some people who are out of the scheme. It's discriminatory, then you must tax it. Number 5, passages. There's something called passages. Passages or traveling. Passages or traveling costs. Passages or traveling costs granted to an expatriate employee. Passages or traveling costs granted to an expatriate employee who is not a citizen of Kenya. Passages or traveling costs granted to an expatriate employee who is not a citizen of Kenya. So again, there are conditions. So passages are usually air tickets or travel costs paid for the employee or his family. It will only be an untaxable benefit if that person is not a citizen. He's only coming here for work, but is a citizen of a different country. But if you give to anybody who is a Kenyan citizen, local, then you tax it. That's the condition. 6, contributions to a registered pension scheme. Contributions to a registered pension scheme. Contributions to a registered pension scheme. Contributions to a registered pension scheme by the employer on behalf of the employee. By the employer on behalf of the employee. Lastly, 7, fringe benefits or loans. Fringe benefits or loans. Fringe benefits or loans. Fringe benefits or loans granted to an employee at an interest rate that is lower. At an interest rate that is lower. At an interest rate that is lower than the market interest rate. At an interest rate that is lower than the market interest rate. At an interest rate that is lower than the market interest rate. So it was 1/1 non-cash benefits, H up there. And we said who pays the tax? The employer, because the employer pays, it's a non-taxable benefit on the employee. Lastly, we look at allowable deductions against employment income, allowable deductions. Allowable deductions. Allowable deductions against employment income. Against employment income. Allowable deductions against employment income. So allowable means you can deduct this first before you can calculate tax. You're allowed to lessen from employment income before you can calculate tax. So allowable deductions against employment income, number 1, subscriptions to professional associations. Subscriptions to professional associations. Subscriptions to professional associations such as ISPAC. ISPAC is the Institute of Certified Public Accountants of Kenya. Subscriptions to professional associations such as ISPAC. Number 2, contributions to a registered home ownership. Contributions to a registered home ownership. Contributions to a registered home ownership savings plan. A registered home ownership savings plan in brackets RHOSP. Subject to a maximum of 4,000 shillings per month. Subject to a maximum of 4,000 shillings per month. Subject to a maximum of 4,000 shillings per month in brackets 48,000 shillings per annum. 48,000 shillings per annum. 48,000 shillings per annum. Number 3, contributions to a registered pension scheme. Contributions to a registered pension scheme. Contributions to a registered pension scheme. Contributions to a registered pension scheme, subject to a maximum of 20,000 shillings per month. Subject to a maximum of 20,000 shillings per month. Subject to a maximum of 20,000 shillings per month. In brackets, 240,000 shillings per annum. Number 4, mortgage interest on a personal mortgage. Mortgage interest on a personal mortgage. Mortgage interest on a personal mortgage used to purchase an owner-occupied house. Mortgage interest on a personal mortgage used to purchase an owner-occupied house, subject to a maximum of 25,000 shillings per month, subject to a maximum of 25,000 shillings per month, subject to a maximum of 25,000 shillings per month, in brackets 300,000 shillings per annum, in brackets 300,000 shillings per annum. So that is what we call employment income. So we'll take a break, but in the meantime, you can take a look at a question they brought last sitting, December 2022. Look at question 3. Question 3C is called Henry Mwala. So after the break, we can look at Henry Mwala. Henry Mwala is December 2022, question 3C. So we look at December.
Sijana anakuja kufanya labda pengine Amina hiyo receptionist
So read this question. So the question reads, this is December 2022. Question 3C. Henry Mwala, who holds a dual citizenship, has been living in Denmark since September 2014. He returned to the country on 17 December 2020 and opened a hardware shop on 2nd January 2021. On 1st July 2021, he secured a formal employment with Best Freight Limited, a logistics company, as a fleet manager. He provided the following information relating to his income for the year. Basic salary is 180,000 per month, fees 46,000 per month. Now he was paid overtime amounting to 30,000 per month and risk allowance of 25,000 per month during the year. But remember, his employment began from July. Yeah? So for that, it's only 6 months. Now the employer paid him, so they provided him with meals worth 5,000 per month. Now he received a house allowance of 60,000 per month. Up to 30th September, he used his personal car for official duties, and the employer reimbursed him a monthly mileage allowance of 40,000. 6 on 1st October, he was provided with a saloon car of 2,400 cc, purchased by the company in year 2019 at a cost of 2 million. He was out of office on official duties for 5 days and received per diem of 6,000 from the employer. 8, the company paid school fees of 80,000 for each of his 3 children during the year. This was included in the employer's books of accounts. So the examiner wants you to interpret if the employer paid tax or not, for you to decide based on that information and decide who between them. Is it Henry Mwala or the employer who's going to pay tax? 9, the employer bought a 120,000 air ticket to facilitate Henry Mwala to visit the rest of his family in Denmark during his annual leave. 10, with effect from 1st July, he contributed 15,000 monthly as pension contribution and 92,000 for life insurance annual premium respectively. Okay. 11, he bought a residential house on 1st September through mortgage of 6 million by Excel Bank Limited at an interest of 16% per annum. He moved into the house on 2nd October. 12, the net loss of the hardware shop during the year amounted to 370,000. This was after deducting the following expenses: salary to the salesperson, VAT, rent, electricity, furniture and fitting, computers required. Determine the total taxable income of Henry Mwala for the year and compute the tax payable. So we want to prepare a statement of taxable income. So for Mr. Mwala, prepare a statement. Taxable income. Yeah. I will always use 2022 because that will be your year of income for your exam. So I'm just rehearsing what will happen in the exam. You're just rehearsing. So just bring the items in line by line, beginning from basic salary. The basic salary is 180,000, but from July, so it will be for 6 months. So 180,000 for 6 months. That gives you 1080. $1,080,000, that's basic salary. That's note 1. Note 2, he was paid overtime per month. So these are cash receipts from employment. So he was paid overtime, and overtime is 30,000. So 30,000 per month for 6 months. That's 180. That's overtime. And risk allowance of 25,000. All those are cash benefits. So you also got risk allowance. Oh, the risk allowance was 25,000 per month for 6 months. So that's 150,000. $150,000 for risk allowance. 3, the employer provided him with meals worth 5,000 per month, so it's already more than 4,000, so it's taxable. So free meals, 5,000 a month for 6 months is 5,000. Or he received house allowance of 60,000 a month. House allowance means he was paid cash. He was not given a house. So he just taxed the allowance. So these are cash receipts. 60,000 per month. Was it 60? Yes, for 6 months. $360,000. 5, up to 30th September, he used his personal car for official duties and the employer reimbursed a monthly mileage allowance of 40,000. So that point has no benefit because he was using his private car and he was using it for official purposes for the business, and the employer was merely reimbursing. Reimbursing means you first spend your money, then he simply, probably you bring the receipts and he pays back. So there's no benefit for him. Whatever he spent was purely, you're told it was for official. So asema is for official duties. So yeye alikuwa anarudishiwa tu pesa zake zile ametumia, hakuna benefit hapo. So note number 5 is not included. Note 6, on 1st October is provided with a saloon car, 2,400cc, purchased by the company in year 2019 at a cost of 2 million. So there's a car, but from October. So October, November, December for 3 months, your portion. So car, unaanza na cc basis. So unachukua hiyo 2,400cc unaenda kwa table, wamepatia prescribed amount is between 2,001 to 3,000. The rate is 8,600 per month or 103,200 per year. So you come here and say 8,600 monthly for 3 months, October, November, December. So 8,600 per month times 3 months is 25,800. You put it aside because you have to compare with the prescribed rate of 2% per month of the initial cost of the car is 2 million times 3 months. The car was only given for 3 months. So 120. Out of these two, you choose the higher. So that's car benefit. Note 7, he was out of office on official duties for 5 days and received per diem of 6,000 shillings from the employer. So you bring in per diem. Sometimes it's called subsistence allowance or subsistence. 6,000 per day, 2,000 per day is exempted for 5 days, and that's 20,000. Note 8, the company paid school fees of 80,000 for each of his 3 children during the year. This was included in the employer's books of accounts. What does that mean? included in the employer's books of accounts. It means the employer charged it as an expense in his books. So kama employer charge kama expense, it means the employer did not pay tax. It was in his books of accounts. So he has used it as an expense. So we must tax him. Because we said it will be a non-taxable benefit, provided it is taxed on the employer. But the employer had included it in its books of accounts. So because they have been included in its books of accounts, it means they've not paid tax on it. They've used it as an expense in their books. So we will tax them. Note 9, the employer bought a 120,000 air ticket to facilitate Henry Mwala to visit the rest of his family in Denmark during his annual leave. So, Mr. Mwala is a Kenyan citizen. Sindio? Okay, actually, wanasema is a double citizen. The citizen wa Denmark na pia wa Kenya. So, because of that, you must tax. Kama angekuwa citizen wa Denmark entirely, they would say he's non-citizen, would not tax it, would call it passages. We would say that's passages to a non-citizen, but he's also a citizen of Kenya. At the same time, he's a citizen of Denmark. So we'll tax these passages. So just call it air ticket. Air ticket ama ukipenda passages. This guy is a citizen, so we'll tax the 120. With effect from 1st July, he contributed 15,000 monthly as pension contribution and 92,000 for life insurance annual premium. With effect from 1st July. So both hizo, unajua pension ni allowable deduction, is not a taxable benefit. Insurance inaitwa set off. You utatoa from tax. Wakati una calculate tax, you deduct the set off. You'll see how we deal with the insurance, but your pension ni allowable deduction, we shall deduct here after all the benefits have been included. 11, he bought a residential house on 1st September through a mortgage of 6 million, provided by Excel Bank Limited at an interest rate of 16% per annum. He moved to the house on October. So hata hiyo ni allowable deduction. We'll come to that. Note 12 is other income. Wacha tumalizane na employment. So the first allowable deduction I want to make is this one of pension. Pension of 10. So utasema less contribution to register pension scheme. You will take the actual. So the actual contribution to pension is 15,000 a month. For 6 months, you must have contributed 90,000 for those 6 months. The set limit is 20,000 per month. For 6 months is 120. And we deduct the lowest. The lowest is 90,000. We deduct that. Then the other allowable deduction is mortgage. He took a mortgage. That's in note number 11. But the mortgage will start applying from the date he moves to his house. And that date is from October. You have to, the house must be owner occupied. So October, November, December, 3 months. And so we also lessen mortgage interest. So mortgage interest, we'll take the actual interest. The actual interest would be 3 months out of 12. 3 months out of 12. I will multiply by the amount of loan was 6 million. At an interest rate of 16%. That will give us the actual interest. Make the apportionment. This gives you 240,000. We'll compare with the set limit. Set limit for mortgage is 25,000 a month for 3 months. If you sum up 25,000 a month or 300,000 per year. So again, you deduct the lowest between the two. So up to there, we are done with the employment income. But he has also business. He has business income. The last note has information on business income. This is what we are told. He had a net loss. So the loss is 370,000, but after deducting certain expenses. So first we want to adjust this loss, right? So let's open a working note here. And you call this note business income. So we call the note business income. So we call it business income. So begin from the net loss. 370. Then you must look at the expenses and add back whatever it is they are deducted, which they are not supposed to deduct. So you have to adjust this loss. First of all, there was salary to the salesperson. That's okay. So he has employees, he must pay salaries. But VAT as a tax should not be treated as one of the expenses in generating profit or any tax. We shall be looking at more of that on the business income. So VAT paid or any tax for that matter is not allowable expense. So add back 180. Rent is okay. You have to pay rent for the business premises where he was doing his hardware. That is allowable. Rent is okay. Electricity is okay. You have to pay electricity. But furniture and fittings is capital expenditure. It's not supposed to deduct there. Furniture is capital expenditure. He has bought an asset. So furniture and fittings, another 250. Then he also bought computers. These are capital costs. Computers is 300. Then we add that. So you get 360,000. But then you'll be allowed to deduct investment allowances on the capital costs incurred. So investment allowances on furniture, for example, is 10%. So we'll take 250,000 multiplied by 10%. So we'll be allowed to deduct 25,000. Then computers. Computers, the 300,000, 25% is 75,000. So you deduct 100,000, you are left with 260,000. So 260,000 is what we tax. That is taxable income. We'll tax the 260. That's what you come here and see, business income. That's other income. Business income from note 1. We add here 260,000. So that gives us the total taxable income for the first part of the question. We call this total taxable income. So what the examiner was asking for, we get by adding everything. This will give you 23,95,000. So do we have any questions? Anyone with a question? So it's easy, isn't it? It's easy, yeah?
Waiting for the instructions.
Yeah,
Waiting for the instructions.
but what will stop you from what will stop you from following instructions? Eh? So we go to the second part. So for the second part, we're supposed to calculate that. So the examiner will give you a graduated scale. Kuna graduated scale pale. Ukiangalia pale kwa table, kuna graduated scale monthly na annual. Hii ni annual income. Kwa hivyo lazima tutumie annual graduated scale. So graduated scale inasema hivi. Inasema from 1 shilling up to 288,000, the rate is 10%. Then 288,001. What have they done? They've added 1 shilling on 288,000 to exclude 288,000. Another way of doing it, I can say the next 388, the upper limit, minus 288. Natoa 288, bala kuongeza 1 shilling. I just say 388 minus 288, so that the next 100,000, the amount you're adding will be at 25%. So let me just apply it here and you'll see. So Roman 2, unasema tax computation. Tax computation. Who is it? The first 288,000 shillings. The rate is, umetongea rate ni ngapi? 10%. 10% of 288 nakupatia 28,800. 28,800. Get 28,800. Then unasema the next. So the next, kwa sababu anaongeza 1 shilling to get rid of 288, I can still get rid of 288 by taking the upper limit. Upper limit ni 388 minus 288 and I get 100,000. Next 100,000 will be at 25%. Here nipatie 25,000. Then kuna rate 2 moja imebaki. So anything else left, you take to that rate. Nasema excess. Excess itakuwa that amount 2395. 2395,000 minus 388,000 at 30%. Anything remaining will go to 30%. So minus 388, 30% to get 602. $100. Then you add in 602, 100 plus 25,000 plus 28,800. That gives you gross tax of 655,900. Sasa ukifikia hapo unaanza ku offset. The first thing you offset is the payee. Uliambiwa payee alilipa 46,000 per month for 6 months. So unasema less tax at source. TS, tax at source kuna payee alilipa tayari. At the source unachukua 46,000 multiplied by 6 months. Hiyo ni 276,000 unatoa hiyo 276,000. Alafu insurance itampatia what we call insurance relief. Insurance relief, you are allowed to offset 15% of the premium, and the insurance must be education of life, not any other insurance. Lazima iwe education, life, ama health insurance. Si ya gari pale. So you have to be careful with insurance because niona language yao inatatanisha kidogo. Angalia note 10. With effect from 1st July, he contributed 15,000 monthly as pension contribution and 92,000 for life insurance annual premium respectively. So yeye alilipa from July, lakini ni kama hiyo language inatatanisha. Premium 92 ni ya annual, kwa hivyo 6 months ni nusu. Ama nyinyi mnaelewaje? Alilipa insurance ya mwaka mzima? What is the case there? What's your interpretation? Hiyo 92 ni annual insurance, we're supposed to get half, ama he decided to pay for the whole year. Unajua ameingia kazi from July, ama alternatively labda alilipa, this is my interpretation, labda alilipa 92 which will go up to July next year, but what applies this year ni 6 months. Hiyo ingine ita apply for next year, so we'll take half. So insurance relief, half of 92 must be 46, ndio utachukua 15% of the premium of 46,000. Which is 6,900. Alafu pia unamtolea personal relief. Tulisema every resident person lazima apate personal relief. Sasa personal relief is 2,400 a month for 6 months. Hizo alifanya 2,400, you multiply by 6 and you get 14,400. So what remains is the tax payable. So that was 655,900 minus 276,000. That was tax at source minus 6,900 insurance relief minus 14,000. Hiyo ni personal relief. Whatever remains is the taxpayer. So is there any question? So tax payable inabaki ngapi? $358,600. So hiyo ndio tax payable. $358,600. $358,600. Any question? So let me give you an assignment you can try. Just the next sitting, kuna August 2022. August 2022, question 3C. Anaitwa Henry Musyoki. August 2022, question 3C. You can try that at your own time. August 2022, question 3C. So that in the next class, tutaenda through that question, alafu tutaanza, or maybe we'll do one more illustration, alafu tutaanza taxation of business. Because sasa tumemaliza employment income, I'll be introducing taxation of business. Taxation of business. All right, so we stop there. So let's pick it from there in our next class.